Social media has hooked young investors on finance, but a growing number are taking more and more risks. Finfluencers and money experts say it's time for some caution. The most important finance news today by MasterDigest. The rise of finfluencers and huge surge in financial content on platforms like TikTok, Instagram, and Twitter over the past 18 months has hooked a new generation on finance and investing. Young investors are spending their spare cash on cryptocurrencies and stocks, with a large number of them following the advice they got from scrolling through social media, lured in by promises to get rich quick and beat the system. Videos tagged #finance, #investing, or #stocktalk on TikTok have billions of views, a total of 7.5 billion at time of writing. Clips hyping stocks that are going to the moon, promising consumers they can easily turn $10 into $10,000, or kickstart a Doge revolution, dominate the financial social media scene, and drown out educational content. Recent surveys have shown young investors are pursuing riskier strategies than older generations. Last month, Barclays research showed 21% of Gen Z investors are investing to take advantage of current market conditions, and 16% are trying to play the markets. Not all financial social media content can, however, be labeled the same. With the same hashtags that promote questionable investment and financial advice, there are videos with sound advice explaining Roth IRAs, how to increase your credit score, or the benefits of long-term investing. Zoom Video Communications Inc., whose online conferencing services took off during the COVID-19 pandemic, agreed to acquire Five9 Inc. for $14.7 billion, using its surging stock to expand into an adjacent market that could bolster revenue as lockdowns end. The value of the all-stock offer is $200.18 a share, based on the closing price for Zoom's common stock on Friday, compared with Five9's $177.60 price on Friday. The company said in a statement Sunday. The target firm will become an operating unit of Zoom's after the deal, which is subject to shareholder approval and slated to close in the first half of 2022. Zoom has been looking for ways to keep growing as workers begin to return to the office and students go back to school. Five9 specializes in contact centers, a market the companies estimate at $24 billion. Together, Zoom and Five9 aim to compete better with the likes of Cisco Systems, RingCentral, and Amazon.com. One of the most closely watched quarterly reports last week comes from Netflix. As the first of the FANG names to post results, the report will set the tone for the other big tech companies still left to post their quarterly earnings. Investors are nervously eyeing Netflix's second quarter earnings report after a sharply disappointing first quarter, during which the streaming giant added fewer than 4 million new paying subscribers versus the 6.3 million expected. The slowing rate of new subscriber additions for Netflix has come along the maturation of the platform in major markets. With nearly 208 million global subscribers, Netflix is still the clear US leader in streaming content, followed by a wide margin by Disney Plus with 103.6 million subscribers. DHL Express plans more than $360 million in infrastructure investments. The world's leading express service provider announced today that it is investing more than $360 million between 2020 and 2022 to build new and expand existing facilities in key growth markets within the Americas region. Additionally, the company intends to spend millions on measures to bolster its Americas air network, such as introducing new direct flight routes. The investments come on the heels of significant B2C and B2B e-commerce shipment growth, where the Americas countries experienced, on average, 33% more shipments per day in Q1 2021 as compared to the previous year. Many of the infrastructure investments will focus on the company's facilities, which include service centers for pickup and delivery operations, gateways that manage the international clearance of shipments, and hubs which operate as shipment transfer points to and from regions of the world. Google and Amazon may have backed the wrong technology. An evolutionary approach to building driverless cars is challenging the companies targeting a moonshot solution to full automation. Since Google launched its self-driving car project in 2009, the biggest challenge has been one of technology. Can it be safe enough to deploy at scale? That dispute is over. Google's project, now branded Waymo, has experienced only minor incidents, about once every 210,000 miles, since 2019 when it began operating a driverless service in Phoenix, Arizona. Cruise, its GM-backed rival, received a permit last month to begin commercial operations in its home city, San Francisco. Both groups are valued at more than $30 billion by the most reputable names in venture capital and tech. What these rivals are not doing, however, is conquering one metropolis after another the way Uber deployed in 100 cities within 4 years of launch. The costs are just too exorbitant, the testing hours too prolonged, and it remains unclear whether there is really a business case for shared robotaxis. Meanwhile, a new threat has emerged. Suppliers of advanced driverless assistance systems, or ADAS, a bottom-up approach to building autonomous technology, are making massive strides. They already have a great business case, generating profits as they sell their tech to car makers, constantly upgrade their systems, and save lives along the way. Several experts say this is a better pathway to scaling driverless tech. If they are right, then the central risk for the robo-taxi hopefuls is not whether full autonomy can succeed, but whether an entirely different approach to the problem will get there first. Driverless groups such as Waymo, Microsoft-backed Cruise, Amazon-owned Zoox, and Aurora, which announced plans for a public listing last week, are betting on a moonshot solution with no plan B. They plan to offer full autonomy, albeit ring-fenced to certain locations, or nothing at all. 2021 is expected to end at $66,284 per Bitcoin. This would be just $2,000 more than the all-time high of $64,234 as of April 14th, 2021. 2021 will probably go down in history as the year when Bitcoin started to enter the mainstream financial world, with an increasing number of global financial institutions, large technology enterprises, and even a nation adopting the crypto king. While Bitcoin will sooner or later come out of the current price correction phase, the majority in a survey of 42 crypto experts globally recently said hyper-Bitcoinization, the moment when Bitcoin overtakes global finance, will happen by 2050. The survey was published this month by the UK-based personal finance platform Finder. The survey noted that 29% said hyper-Bitcoinization will happen as soon as 2035, while an additional 20% believed it to happen by 2040. However, 44% of Bitcoin panelists didn't expect it to ever occur. Bitcoin has managed to gain increased backing or attracted the interest of companies and financial entities across the globe, such as JP Morgan, Goldman Sachs, PayPal, Visa, Tesla, Apple, MicroStrategy, and more. Women make up nearly a third of financial service firm boards. Report says the proportion of women on the board of Britain's top 200 top financial firms has grown to nearly a third in 5 years, as the government launched an initiative to improve the gender balance in the sector, a report on Monday said. Think tank New Financial said in a review of the charter's impact that since the launch of the HM Treasury Women in Finance Charter in March 2016, the number of women on board at companies has increased from 23% to 32%. Meanwhile, female representation in executive committees had increased from 14% to 22%. Based on the current rate of change, women will reach equality in boardrooms in 2029 and on executive committees in 2033.